What if the secret to making money in the stock market is actually learning how to protect yourself from losing it? Benjamin Graham, the father of value investing, had a simple idea that could completely change the way you look at investing. Don't just ask how much you can make. Ask how much you could lose if you're wrong. In this video, you'll discover what the margin of safety really means, why Graham considered it essential, how it protects investors from mistakes, and how you can apply this principle to your own financial decisions. Because sometimes, the smartest investment isn't the one with the biggest potential return. It's the one where you have the most room for error. The concept comes from Benjamin Graham's classic book, The Intelligent Investor. At its core, the margin of safety means this: buy an investment for significantly less than what you believe it is actually worth. Imagine you analyze a company and estimate that its intrinsic value is around $100 per share. But instead of buying it at $100, you wait until the market price falls to $70. That $30 difference is your margin of safety. Why does this matter? Because your estimate could be wrong. Maybe the company grows slower than expected. Maybe profits decline. Maybe the economy enters a recession. Or maybe you simply made a mistake in your analysis. The margin of safety gives you a cushion. Think about it this way. Imagine you're building a bridge. Would you design it to support exactly the maximum weight you expect? Probably not. You would want additional capacity. Because real life is unpredictable. Investing works the same way. You don't know exactly what will happen to a company, the economy, interest rates, inflation, or the stock market. So instead of trying to predict the future perfectly, Graham's philosophy was essentially: prepare for being wrong. This is one of the most powerful ideas in investing. You don't need perfect predictions. You need decisions that can survive imperfect predictions. One of the biggest mistakes investors make is confusing a great company with a great investment. A company can be excellent, and its stock can still be overpriced. Imagine a wonderful business worth approximately $100 per share. If investors become extremely excited and push the price to $180, buying it simply because it's a great company could still produce terrible results. Why? Because price matters. The better the price you pay relative to the value you receive, the greater your potential margin of safety. This is why value investing isn't simply about finding good businesses. It's about finding situations where price and value are disconnected. And here's something important. You don't have to be a professional investor to use this principle. You can apply the margin of safety to your personal finances. For example, if your monthly expenses are $2,000, don't build your financial life around earning exactly $2,000 every month. Create a buffer. If you want to buy a car, don't calculate your budget based on the absolute maximum payment you can afford. Leave room for maintenance, unexpected expenses, and changes in income. If you're investing, don't assume your investments will always generate the returns you've seen in the past. Build your plan assuming that reality could be worse than expected. That's the margin of safety mindset. And this leads to one of the most important lessons from the intelligent investor. The goal isn't to eliminate risk. You can't. The goal is to make sure that when something goes wrong, it doesn't destroy your financial future. A margin of safety doesn't guarantee that you'll never lose money. It simply improves your position when you're wrong. And that's incredibly important because investing isn't a game where you need to be right every single time. It's a game where surviving your mistakes matters. So the next time you're thinking about buying an investment, don't only ask, how much money could I make? Ask, what happens if I'm wrong? And then ask yourself, do I have enough room for error? That's the margin of safety. A simple concept, but one that can completely change the way you think about money and investing. If this video helped you understand investing from a smarter perspective, subscribe to Money Momentum for more lessons on personal finance, investing, and building long-term wealth. and tell me in the comments. Would you rather have a higher potential return or a bigger margin of safety? I'll see you in the next video.